Good afternoon to our friends here on the East Coast, and good morning to our friends in the Central Mountain Pacific. This is Anthony Mento here at Life Brokerage. Appreciate your attendance. We're going to do a short webinar. We feel as though it's very timely, involving a proprietary IUL strategy, making use of volatility-controlled indexes. There's a lot of confusion around volatility control, what it is, how it works, how managers will diversify away from the hot and volatile aspect of the S&P 500 and reallocate to better value, lower volatile companies within the S&P. And what this accomplishes several goals. One, it keeps option costs down because you're controlling the volatility, right? High volatility translate to high options costs. So, this is extremely important in today's environment when you're constantly seeing caps of major insurance companies come down and down and down and down. And if anyone is reading Bobby Samuelson's Life Product Review, you'll see that a very insignificant drop in a cap will create a very significant disparity in cash value IRR in the long term. So strategies that are financed using high cost products, multipliers, cap dependent solutions are really struggling at the moment. So I have on the line my friends from Nexus, James Hahn, John Elder. They're gonna jump in and share in this presentation. So we promise to keep this to a 12:15 finish. Hopefully you've all grabbed a little bite to eat and we're able to listen in, and we'll, if possible, we'll save all the questions until the end. So quick agenda, what is it? How does volatility control work? And what is this zebra edge that everyone is talking about? So first and foremost, I'm going to try and grab your attention right off the get-go, and I'm going to share with you an analysis that I did for a very important agent that we work with in Texas. And what you're going to see is that we position the Nationwide New Heights product right in the middle here, and we compared it against a leading IUL carrier A and a leading IUL carrier B. We'll leave the names off here. And this is a 45-year-old male, $200,000 10-pay, assuming a 5.5% crediting rate in New Jersey, and we ran an income solve. So, you're dropping $200,000 into the contract, and immediately you want to see what dollar amount is going towards the fixed charge. And you'll see that the carriers are somewhat in line until you look at total fixed charges, including premium expenses and loads, and you'll see that the Nationwide product with the New Heights option is far more efficient from a charge perspective, which will translate to how this volatility control indice works, how a down market will affect your performance, and subsequently give you a more predictable, smoother outcome than some of the more volatile S&P type cap multiplier strategies. And what you'll see here is cumulative charges, which I believe are extremely important when selecting an IUL. And then what does the income look like at a 5.5 or call it 70% type model? And you see that the New Heights solution is far superior than these two additional leading companies. So let me take a step back, and I'll turn this over to James Hahn for a couple minutes here to describe a Nexus and how these products were developed, where a Nexus came from, and just a little background on what they do and how this product came to market before we dig into the nuts and bolts. So James?
Yeah, thanks. Yeah, I'll jump in there real quick here. Well, good afternoon, everyone. Thanks so much for jumping on this call. And as Anthony said, we'll keep this to that 15-minute window. Real quick, I wanted to share who a Nexus is. At our core, Nexus is a product development company based in Scottsdale, Arizona. We've got 16, 17 different actuaries that work together with our product team here in Scottsdale in creating various IUL products, specifically nationwide. And from there, what we do is the whole objective is provide a better consumer outcome at the end of the day. And we're just simply trying to provide your client a better experience, an opportunity to meet the expectations and exceed the expectations on what's being shown on the illustration. It really, at the end of the day, comes down to the actual client delivering on the expectations and give them a better outcome. The other part that I want to share with you is it's how we go to market. You know, we only go to market with what I would say hand selected in a sense. Anthony's a friend of mine, but I also highly respect his business model and how he attracts high-end advisors who aren't your typical advisor. You all think a little bit differently. So the selection process is very important to Nexus. We've got 17 different firms throughout the country that have access to the nationwide product, and we're very proud to represent Life Brokerage on the Nexus platform. And the last part of the conversation I want to share with you, not only do we build the widget, the actual IUL with Nationwide, we also build the various indexes, and we're going to talk about that today, which is Zebra Edge, that was built by Nationwide, Nexus, and Roger Ibbotson. But we work with various investment banks and some of the smartest people on Wall Street, like a Roger Ibbotson, or investment banks like JP Morgan, UBS. At the end of the day, when we package all this up, it's really about you. It's about providing you something uniquely different that you can go out to the marketplace and help your current clients, but also at the same time attract new customers to have access to something that's proprietary in nature. Anthony, go ahead, bud. Thank you.
Thanks, James. So here we are, right? The product is a low-cost IUL design. It's a proprietary index option. They're uncapped, right? So you're not constantly delivering bad news and recalibrating income solves and remodeling finance templates because your caps are coming down like prior products. These are high participation focused contracts. The biggest selling feature, in my opinion, and the biggest area of comfort that I get when recommending this particular strategy is that although the participation rates are anywhere between 115 and 180% uncapped today, they're guaranteed never to go below 100. So if you look contractually at some of these other spread or multiplier type contracts, some caps are guaranteed. Their guarantee floor is like 2. So a cap at 13% a year ago can conceivably go down to 2, right? Some uncapped strategies from the competitors, you're looking at a 30 or 40% guarantee for the participation rates. So there's a lot of wiggle room there for carriers. And what Nationwide and Nexus have teamed up to do is give the buyer a level of comfort that, given the environment we're in, participation rates, uncapped participation rates, will not go below 100% in their volatility control accounts. So, here we are, right? And if you've attended prior webinars, you've seen the content that we put out. The next 10 years are not going to look like the prior 10, right? And we're getting information from the heads of Morningstar, JP Morgan, I mean, you name it. And you look at we're coming off of the 10-year U.S. equities of the strongest bull market in 45 years. And multiplier products did extremely well in these bull markets. Products built with higher charges that passed along higher rewards, right? And this isn't a debate over which product design is better, or just an education on how these higher charge, higher multiplier type products worked so well in a consistent bull market. Now, as we see interest rates decreasing, we see caps decreasing, options budgets decreasing, potential passage of AG 49A, we start to grow very concerned with policy charges and long-term performance and long-term sustainability. And the last thing we want is more attention like our industry received in January of 2020, where consumers really weren't aware of what they were buying. And again, if you're following the Life Product Review and the industry and trends, what you're seeing is that all these products were built on a 4% options budget, and you really can't get to that point any longer. So if you take Wall Street forecasts from 16 different firms, the total S&P index return includes an average annual dividend of 2%. So we bake that in. Over the last 10 years, the total return with dividends is 13.6% return, annualized gross return. If I take the dividend out, I have the S&P price return. It's not the total return, just like it sounds, because we've removed the dividend. And that comes down to an 11.6% annual gross return. If you take the assumptions of these 16 Wall Street firms and you look forward the next 10 years, the prediction is at a 6.62% total return and a 4.62% price return, removing dividends. So IUL products will be dramatically affected by these modest type returns, whereby in this bull market run, the IULs with higher charges equal higher caps equal higher multipliers performed extremely well. So what we're seeing already, just since the beginning of 2020, is lots of corrections in options budgets, decreasing caps, and lower type returns. So let me just jump into volatility control, because there's a lot of mystery around this. Industry prediction. This is just heads of firms and insurance companies. We feel as though AG 49A is going to pass, and the juice of the multipliers are no longer going to be worth the squeeze. Caps are going to continue to come down along with options budgets, and the takeaway is that volatility controlled indexes will become more popular amongst IUL. And the volatility control keeps option costs down and manages through turbulent times and creates more predictable, smooth returns. So I promise to send these slides out because there's a lot of misunderstanding about volatility control. So volatility is the degree of variation of a trading price over time, as measured by the standard deviation. So the S&P indices, like the S&P and the Dow, are very volatile indexes, and therefore call options are more expensive. So insurance companies can't possibly afford to give you 100% with unlimited potential in these options, and therefore they create a cap. So they buy at strike prices at lower cost of, say, 9 or 10% of a cap, because those call options are less expensive. So if you introduce a volatility control index, now you get to control that volatility at or near a certain level. And the price of that call option is much cheaper. So when you hear what is a 5% volatility control, a lot of agents, wealth managers, they think you're targeting a 5%, but it's really not looking at 5% growth. You're looking to manage at 5% volatility. So as an example, as a benchmark, since 1950, the S&P has averaged a 15% level of volatility. So that gives you a benchmark, right? During this period, the S&P 500 volatility has been very low, 10% level, and at times much higher, ranging near the 25% level. So as a rule, when we see market corrections like we did in 2008 and like we just did in 2020, volatility levels increase dramatically and the cost of options go up. A 5% level would tell us that the goal of the index is to maintain a much lower level of volatility by moving into different allocations of cash, or you'll see certain companies like Allianz look to bonds or commodities. So by using the lowest volatile stocks in the S&P 500 or a blend, therefore, you can control volatility and therefore control costs. So if you look at historical market corrections of 10% or more since 1997, you'll see the S&P took some pretty wild rides through this time period. And the key is, how do these volatility controlled indexes, if you'll focus on the right side here, how do these volatility controlled indexes, which we're about to touch on in the next couple of minutes, create a quote unquote smoother ride? So, if you see the Zebra Edge at a minus 2.2% during these corrections, these 13 points that experience a 10% or more loss, you see the Zebra Edge performed at with lower volatility at a minus 2. Now, if you look at,
if I could just throw something in there, it's interesting. Your point is so solid. This is James. That smart S&P, the Zebra Edge that he's highlighting here at -2, that's simply the averages during those old correction periods. That's the average. Where if you look at the S&P, the raw S&P was down. It was a -19. And there was even periods of time on that previous slide, it was as much as 55% volatility in the negative, right? So, a -19 average versus a -2, that just smooth it out, kind of keep this thing steady, consistent. Back to you, Bud.
And then you take into account one of the selling features of IUL is the ability to reset. So after these corrections, you get to reset at the new floor, and you look at 1 year post recovery, and this Zebra Edge still has the juice, despite the volatility control, to bring back a percent return. 3 years after recovery, 26% return, and then 5 years after the recovery, 44% return. So you're kind of smoothing out the downside while maintaining all of the upside. So I'm going to turn this over just very quickly, and this is where I'm going to turn this over to John Elder, and we'll wrap up here in the next 3-4 minutes or so. What got your attention to sign up and attend this webinar is the article that I shared by email, that at halfway point of 2020, just 25% of the stocks in the S&P 500 have actually posted a gain. That means 374 of the 500 stocks are in the negative. And you see stocks like oil and gas and travel and hospitality, some of them down 70%. So if you can partner with an indice that will model volatile behavior and kind of diversify away from the hot, quote unquote, the hot or the highly volatile, and focus on the more stable stocks in the S&P 500, you have a recipe for success. So in the next couple minutes, we're going to turn this over to John Elder, and we're going to talk about the Zebra Edge, which is an alternative to the S&P using behavioral finance, created by Tom Haines, and uses the strategy of Robert Ibbotson. So John Elder.
All right, thank you guys. Thanks James, thanks Anthony. I like what James said a moment ago. He mentioned smart S&P. So when we're going through these next couple slides, remember that conversation about smart S&P, because when you have design from the indexes in the industry and the index universal life world, right, you're looking at about 60 to 70% of those indexes are strictly all S&P 500. We all love the S&P 500. We've all gained and harnessed a lot of volatility there. However, this index, okay, this is an exclusive offering, U.S. equity index, that New York Stock Exchange Zebra Edge, designed by, like Anthony said, Professor Roger Ibbotson and his team at Zebra Capital Management, to provide an opportunity for higher long-term returns with less risk. That's right, less risk through behavioral finance. And as you can see here, we don't have to go through all the bullet points on Roger Ibbotson, but the fact that this gentleman was mentored by 4 Nobel Prize winners and came up with a solution called behavioral finance. And that is the rebalancing nature of this index. Keep in mind, this is a quarterly rebalancing process. We can still have the full S&P 500, okay? Zebra Edge is the full S&P 500. But what we do through a filtering process called behavioral finance, we remove the top 300 most popular and overpriced equities, or we call them toxic stocks that have no room for growth, okay? And what that leaves is the remaining 200 that has the most ramp for growth for the clients to provide decent returns, more consistent, smooth sailing. You're looking at singles and doubles, since it's quasi-baseball season or potentially baseball season right now. You're looking at singles and doubles, getting on base consistently. And like James Hahn, my mentor, says, you take that emotional roller coaster away in this index from somebody that likes to follow their investment. You take the emotional roller coaster away. So very simple, high level. Once again, this is a smart S&P. This is not just throwing money, allocating money into an index and taking from point to point, although it is a point to point, but it rebalances on a quarterly basis. And this shows you that the benefit of this rational long-term strategy. This is simply the raw indexes. The S&P 500 price index in the black, simply since 2000, had returned a 4.17 raw return. Okay, through the behavioral finance process, removing those overvalued toxic stocks, the Zebra Edge simply outperforms it. Takes that huge emotional roller coaster away. Then you start adding on the fact that it's validated and tracked by the New York Stock Exchange. Okay, and I will tell you that this is the only index inside of an index universal life contract that is tracked and validated by the New York Stock Exchange. So that's a big aha when we designed this product and using Roger Ebbetson here. So James, anything else you want to follow up on that as far as New York Stock Exchange?
Yeah, I would just add just one more thing to that. I'll let you pass it back over to you. The other key thing that I think I want you all to hear too, it's, we talk about singles and doubles. When you start throwing that par rate, like what we're looking at here, 145% uncapped par rate, or a 1 year point to point, or the ability to buy up on a 1 year, you can see on the far right hand side, you can buy up for a 1% asset based charge for another 30% uncapped. When you start asking for singles and doubles, 5.5 to 6% return, what you're going to find is your average is somewhere in that 7, 8, and 9s. So we're not looking for the home runs. We're looking just to get on base, as John said. And the other thing that's really important as an IUL, when you think about life insurance diversification and using IUL as part of that, you want to maintain those par rates. So if we pull out, as John said, those toxic stocks, the highly volatile parts of the S&P, you're able to afford a higher par rate and maintain those par rates versus par rates dropping and so on and so forth. So I just want to hit that home.
No, that's a great point. Great point. And then, as Anthony mentioned too, remember when we talked about consistent, volatility control and setting numbers or algorithms inside of contracts. Look at that 0% guaranteed index strategy fee. That's our core at its best right there. You have a 2-year at 145. And remember what Anthony said as well at the beginning. One of those 3 bullet points, that my favorite one is a strong guarantee. You're not going to see a lot of these levers get moved around when volatility starts hitting. You're guaranteed no lower than 100%. Okay, just look at the industry as a whole. Okay, this puts us in a really good position. You've got a low cost offering, guaranteed 0% index strategy fee unless you choose a buy up. Okay, unless you choose a buy up, you're just in a really good situation to have your policy actually perform the way the client thinks it should in their favor. So that's what I like about these options here.
One more thing. Anthony, I'm going to throw one back to Anthony here, but one of the things too, that as an advisor, if you love the S&P and you enjoy having that as an offering for domestic, we've got you covered here. This is just a different way of looking at it. We're not just going to anchor you to 500 equities of the 500. As Anthony said, there's 4 or 5 stocks on a year to date that have really driven about 80% of the actual return. We're not going to put that anchor on your client. We're going to do it in a smarter way. And we're just simply going to get rid of the toxic, overpriced, over volatile every quarter. And we do that every quarter. So just smooths it out, maintain your par rates, as well as provide you an uncapped strategy that provides, that consistent, stable return. Anthony, back to you, bud.
Yeah, thank you, gentlemen. So you hear James and John mention singles and doubles. Well, guess what? At these increased participation rates, right, at 145 and 115, so now your singles and doubles are stretching into doubles and triples. Right. Okay, so think about, right, your singles and doubles, 4s and 5s turn into 6, 7, and 8s with elevated participation rates.
Good point.
So, right, with a high batting average, if you look at it that way, right?
With a high batting average. So, quick chart on back testing and how the products would have performed. Where I want to close with this is, and I'm way over time, and I apologize, and I think this is our first try at a 15-minute webinar, and it's been tough to stay within the parameters. But I do want to show you an offering that Life Brokerage has put together. It's a plug and play. We can download directly from the carrier software and back upload back into an insurance ledger on a one-pager, and we can really get into the charges, right, and policy charges and how they compare with management fees and taxes. And we did an entire webinar on this subject matter. So it's just a reminder on how you can take advantage of these lower cost options and really showcase, okay, this is what my policy charges really cost. And the misunderstanding that insurance is quote unquote expensive can be, we can debunk that very, very quickly using the math in this software package. So if you have any follow-up questions or potential case design that you'd like to see, please reach out to myself or your marketer at Life Brokerage. I promise to send out a recording of this entire presentation along with a copy of the slides. I thank you for your attention, and given the time, we won't take any questions. However, when we email you the recording and copies of the slides, please feel free to reply with your questions, and we will personally answer each and every one. And again, I thank you again. It's now approaching at 12:30. We, again, love your business. Hope you'll find the strategy we've just showcased helpful in your practice. And everyone stay safe, and thank you again. Bye-bye.
Thanks, Anthony. Take care.